Hello, welcome to an episode of Now Next Later live from MBA Annual. I will start by sort of setting up the episode a bit. We had, as conferences go, everybody will probably watch this later since many of our viewers are here. But Sasha had another meeting, so she jumped to that. And so I invited Rob Crispin to join us. So he'll be jumping on momentarily. And I thought we were going to go through some of what we're seeing and hearing here at the conference. So Rob, I was just telling the audience that we're pulled in as conferences go, meetings move around, and ask you to step in or extend a meeting. So Sasha's doing that. And I said, Rob's going to join us. We're going to talk a little bit about what we're seeing and hearing at the conference today.
Hey, Jeremy. Can you hear me okay?
Thanks for joining. I can. Can you hear me okay?
Yeah. I think
Excellent.
both of us are speaking in somewhat hushed tones because we're in a public area.
That's right. I'm one who is willing to make a scene if I need to, but I didn't think this was the right time. So
Well, go on.
So I thought one of the things that might be helpful for us to do is, we've only been here for about half the conference so far, maybe not quite even, Sunday, there are always receptions, even some early meetings, there's the kickoff, and then Monday, everybody's busy. And then there's, people leaving Tuesday afternoon, Wednesday. So I was curious, like, has there been anything that surprised you? Has there been anything you heard that you'd be like, oh, that's worth talking about, reporting out in the sort of short time that we've been here already?
Yeah, I would a surprise, not so much. The What I'm hearing is that, as usual, there are a lot of great third party provider slash vendor offerings,
Mm-hmm.
which are neat. Uh, the I'd say the optimism that we had a few months ago has dissipated to a great degree. A lot of people, we had that 2 minute or two-minute 2 day refi boom, and everybody got excited and they
Yeah.
said, oh, and then the Fed, cut, yada yada yada, and suddenly it's like, oh, how are we going to start hiring again and so forth and call up the
Yep.
people we laid off. But now it seems like some of that has, like I say, dissipated, and the realization that, all right, rates are where they are and they're here for a reason, and let's just make the best of it. And let's everybody go back to their jobs kind of thing. I think that's the sense that I'm getting. And I got to the event Saturday afternoon because I wanted to sit in on the capital markets session yesterday, and I'm glad I did. So anyway,
I
um,
saw the speaker list for that capital markets committee, and it seemed like they got a really good panel of all the GSE and Govy securitizers. So the MBS securitization platforms, FHFA was there with Ginny, Fannie, and Freddie. So that seemed like that must have been a good conversation. Like you said, anything come out of it that's what you're able to talk about?
yeah. Well, I'm not. Yeah, I'm not. It's tough when you are, and I know you're a very forward-thinking person. You have a reputation in the industry as forward-thinking and looking at the horizon and not too much in the weeds. But when you are a company, especially when things were really tough in 2022, 2023, and the GSEs or FHFA comes out with some 5 year plan, well, you're just hoping you'll be in business in 5 months. You don't really care about 5 years from now. Um, Yesterday was like that to some extent. Frankly, the GSEs were there. It wasn't a it wasn't a unicorn rainbow kind of meeting necessarily.
Mm-hmm.
There was some contention that focused around the Fannie Mae and Freddie Mac changing their guarantee fees and without warning,
Mm-hmm.
which is basically just a tax on lenders. They can't hedge against that kind of change. And all it is putting money into Fannie Mae and Freddie Mac's pockets when the credit quality is unequaled, huge amounts of equity, the processing of loans has come a long way. And so it's like, really, Fannie Mae and Freddie Mac, do you really need to raise your G fees like this? There was some problem with that. There was a discussion about how Fannie Mae and Freddie Mac are not doing things that they can do to promote new construction. Like, how about a program for new construction? Fannie
Yeah,
Mae and
forward
Freddie Mac
funding or something. Yep,
yeah,
yep.
some kind of do something,
Yeah,
you know. And we can wander around, complain about inventory all the time, and Fannie Mae and Freddie Mac can say, "Oh, what was me? You know, there's no inventory," but they're not doing anything to financially
truly.
promote new
Yeah,
construction. So
interesting.
it's fine to help first time home buyer, but if there are no houses to buy, then you're stuck. So
I want to take you up on two of those comments. I'll start with this latter one and then move backwards. But I had a really good experience last week. Dan Gilbert's family foundation in Detroit is committed to, among other things, innovation, entrepreneurship, and housing. And we cut the ribbon on 7 new factory built homes on the ground in Detroit. And Fannie and Freddie came and spoke at the event about the importance of urban infill in particular and where factory built housing can help urban infill. And to your point, I know they've loosened or at least tried to address some of their guidelines around manufactured housing, but I really love that it's coming up at the committee. I really love that it's coming up at the committee because that's exactly the type of stuff. There should be more products, more funding around, especially new supply. Urban infill, factory built housing is one that I care deeply about, but there's so many other opportunities too. But that was a pretty cool thing for this project.
well, that's good to hear. And what was the
Yeah.
second thing you wanted to mention?
The G fees, it also feels doubly punitive because I was outspoken a lot this summer when the second quarter numbers came out about repurchase and seeing the number of repurchase demands from Fannie and Freddie, particularly Freddie Mac, in the second quarter of this year to drive repurchase demands up and increase the G fee when I thought you made the key point, when credit quality is better, data integrity is better, and deliveries are better than ever before, seems like really odd timing. So I was outspoken at the time of like, why are we doing repurchase demands at this volume when this is, I would argue, and I think a lot of mortgage companies would argue the best it's ever been as far as deliveries go. And then to raise the G fees on top of that feels like a kick and a punch, so to speak. I mean,
I agree. The Freddie Mac apparently has a program in place or is about to roll a program out next year that is a fee-based program where if you pay fees, you
okay.
can eliminate repurchases. We'll see.
So
We'll
like a
see about that.
self-insurance. Yeah, yeah. Kind of like a self-insurance type thing.
Yeah, pretty much.
I'm glad you said that because I had heard as much, but I just kind of put it in the rumor category and I've been pulling on that thread.
Yeah, it's a out there. They put Freddie Mac and brought it up, but it's the agencies are worth I think 140 billion or 140 million. No, 140 billion.
40 billion, right.
And why do they need to raise the 2 or 3 or 4 basis points when volumes continue to be down and the industry, the environment doesn't seem to warrant it?
Yeah.
That's the problem. Ginnie Mae, getting back to who was there, Ginnie Mae talked. Ginnie Mae is known for dealing with trillions of dollars of mortgages with 120 or 180 people, and they, I guess, are focused on data integrity. Everybody seemed to bring up green bonds, green mortgages, green energy efficient home loan. I should say home loans dealing with energy efficiency, which was nice to see.
That is.
But it's yeah. There were some promising things.
Yeah,
but
that
the
does
industry
sound
is
like
upset about the G fee. The seemingly arbitrary G fee increase it just wonders in the bottom line when they really can't afford it.
yeah. I'm on a panel tomorrow talking about new opportunities to elevate your business. And one of the categories of questions that we're going to go through in the hour is renovation and green as it relates to 2 things in particular. One, that customers do want to hear about it. We know it scores really high on market research. Like people love to hear, like, what are my options? They do respond to a green message. There's no proof they pay more for it yet. We haven't quite figured that piece out, but we know it tests really well in the market research. And then the second thing is almost all the data indicators say that renovation is going to become even bigger of an industry than it already is. People are staying in their homes longer, they're working longer, they're sitting on more equity than ever before, and they're going to use that equity and use that the lifestyle change to upgrade the house they're in. And so one of the things I'm thinking a lot about is how to create the ecosystem, how to create the flywheel where renovation gets a lot easier, and particularly green renovation, because it lowers the cost of home ownership over time. So you have to do the investment up front, like anything. But, my parents were always the ones where they bought the car, they didn't lease it, and then they took care of it. And, our Subarus had 300,000 miles on them growing up. And in many ways, like if you think of green that way, if you invest in the house and you keep it up, you change the oil, so to speak, on your HVAC system and your insulation, like you can lower the cost of your energy bill and your house over time. We just, as a mortgage industry, haven't really like unlocked it yet. But I think that's one of the things that's nice to hear them talking about it from a liquidity perspective, because that'll help the sales folks for sure.
Yeah. So I talked a little bit about what I saw yesterday afternoon in the Capital Markets Committee. What have you seen? When did you arrive, and what have you been
I
doing?
got in late. Yeah, I got in late Saturday night so that I could take some of those Sunday meetings. So kind of that last flight in on Saturday, but then that allowed me Sunday to have a couple really interesting meetings. I think the two things that stood out from my Sunday meetings, one, data mapping, and I don't mean within the company, I mean your lending patterns, subscribing to a data service that tells you what kind of lending patterns you have, what type your competitors have. It keeps your referral sources honest. So the names in that space, the Ingenious is an example, met with them yesterday, and it was really interesting. MMI is another one that comes up in that space. It was really interesting to hear how many lenders, and increasingly smaller and smaller lenders, are getting access to pretty powerful data dashboards and data modeling around their businesses. So I thought that's going to be a trend that only continues in 2025. I think we're going to see a race to get data, use data in new ways for recruiting, for your affordable CRA lending pattern type stuff, and then also just to validate the market. How am I actually doing relative to my competitors? And that data is getting better and better. So that was one thing. I think the other thing that you might appreciate, because it's one of those wild, it is one of these newer trends, and I'm just not sure how pervasive it is, but hiring real estate agents as W-2 licensed employees so that you can pay them for origination. And it creates a lot of controversy. It also creates a lot of discussion, especially among ex-lawyer mortgage types like me. Got my brain firing on all cylinders. But does seem to be a trend of some IMBs like bringing on part-time LOs who are also real estate agents, and then doing deals. And I'm not sure if you've heard that, but that was one thing that I was tracking a little bit yesterday.
Well, that's funny you bring that up, because I was in a kind of a group session with a bunch of mortgage folks this morning, and that topic of dual licensing came up. I was just in Florida last week, and I was surprised how many dual licensed LOs and real estate agents were in the room.
Mm-hmm.
And so that said, the consensus among the folks I was with this morning was, or consensus was, we're not there yet. From my perspective, I see it as two different skill sets. I think, yeah, both financial services, but if I'm a loan officer, I don't want to be dealing with negotiating a purchase offer at 6 o'clock on a Saturday night.
Mm-hmm.
And there are, interestingly enough, apparently the majority of aggregators will not purchase loans that are done by dual agent loan officers or
That's
dual
interesting.
licensed loan
Mm-hmm.
officers. They see it as a conflict of interest. Until aggregators, until investors change their mind on that,
Mm-hmm.
it's going to have limited acceptance out there.
Mm-hmm.
Folks this morning were thinking that, no offense to anybody who's dual licensed on this phone call, but if you're really good at being a real estate agent or really good at being a loan officer, you're probably not going to say, oh, in my spare time, I think I'll sell real
Right.
estate. I think I'll, process a loan. And
Yep.
so the quality is the level of quality remains to be seen among the people who are doing both, kind
Yep.
of master of all trades
Or
or jack of all trades,
jack of
master.
all trades, master of none. Right. Yeah. That's
What
so this,
hearing anything that I mean, do you see that though as the future that you'll have people who do both increase in numbers?
so I'm glad you asked. I've been thinking about this a lot. And there's I'll kind of back into my answer with the challenge question that I threw out to the industry last month, which was if we are talking so much about cost of home ownership and the cost of buying a house and getting new people into the American dream, how are we going to balance that with 6 licensed professionals who all expect to be compensated as a licensed professional for their expertise in this transaction? Seller's agent, listing agent, buyer's agent, mortgage loan officer, appraiser, title attorney or title agent, closer, inspector. And I just think that something's going to have to give relative to both technology and cost. And I don't know that it's going to be people, and I don't know that it's going to be one of those roles. But if we're putting downward pressure on price and we're forcing the issue around transparency and cost at both a regulatory and operational level, something's got to give. And so what I tend to think is you're exactly right that it's very difficult to be good at multiple jobs at the same time. I do think we'll see more and more ways that the primary borrower relationship, the primary customer relationship does more of the quarterbacking, more of the guiding, and has technology tools and other resources more than we've ever seen before. So I do think there is a risk to both the mortgage and title industry that the real estate agent comes out of this disruption as sort of your primary point person. And instead of 2 handoffs, which essentially creates like, okay, now I'm going to hand you off to your mortgage expert. Let me know how it goes. And then the mortgage expert says, now I'm going to hand you off to the title. You guys are going to go close the loan. Let me know how it goes. I don't think that can continue. What replaces it, I haven't quite figured out yet, but something's going to replace that. And I think if the mortgage expert wants to be the expert of debt management, how you finance debt, how you think about debt over your life or over the course of a home, there has to be something's going to have to give how that relationship with the real estate agent and then future homeowner is managed from the beginning, because there's a lot of pressure right now to displace somebody to try to lower that cost.
I need to switch gears with you. I need
Okay.
to ask you something that continues to be and what we go till half past the hour. Is that the
We do. We got about just under 10 minutes left.
all right? And I know you've talked about this before, but it continues to be a topic that's in the hallways, and I like talking in the hallways, and I talk
Yeah.
about in my opening paragraph of my commentary, I talk about this is what I heard in the hallways.
Yes.
You know, all this great technology and all these great vendor offerings and the amount of technology and then now, AI, and for a while there used to be blockchain,
Mhm.
but the price of the loan is still, 12 or 13 grand or whatever it is. And yeah, that'll probably come down a little bit, but
Mhm.
it's ratcheted up and up and up. Is that only due to compliance, or is technology actually costing lenders and therefore the consumer more than ever?
When I look into the data, and then you anecdotally ask mortgage companies what it feels like as well, and you get the qualitative and the quantitative, and you put them together, it seems like technology is 1C. They're all 3 that you mentioned are big: people, compliance, technology. People still is 1A though. Everybody's telling us in the data that the cost of compensation, particularly variable comp, meaning your commission, is 1A, 1B compliance, 1C technology investment. One of the reasons, at least I've identified over the last year, that people and technology continue to be a cost is actually that when you implement technology, you don't trust it enough, is what we're finding. That mortgage companies implement the right tools to the point you made earlier about the service providers and vendors that are here. They find them, they implement them. And let's say it should be, we'll just call it 100% savings in category A. The lender feels a little nervous about trusting the 100% savings. So they only account for or only claim 30% of the savings or 50% of savings. And what they end up doing is paying more because they didn't take full advantage. And now they've got the people and the technology. And they didn't actually benefit from the efficiency because they were too tentative to trust the technology. I'll keep the people just to make sure my vendors are honest. I'll keep the people just to make sure that the technology works. And then I never actually end up getting any efficiency or cost. Now, this is not an advocacy for getting rid of people, but this is an advocacy for trusting technology and moving people to more valuable activities. So we mentioned renovation earlier. One of the things I tell mortgage companies all the time is trust the technology, have the technology do the mundane stuff, and get your people working on new stuff like renovation that you don't have today that you should have, as opposed to thinking about it as I got to get rid of them. And the growth in those new areas will far exceed, if you plan it right, would far exceed your expectations. And so that's where I land on that, is that we're still not trusting technology. And it's costing us.
So let me ask you a question that I bet you've never been asked before. You go out here in Denver and you go to the local 7-Eleven and you buy a lottery ticket and you win $5 million with the caveat that you either have to invest in a third-party provider or create a third-party provider / vendor or
Okay.
start a new little mortgage company. What do you do? That $5 million.
I think I would start a mortgage company with that $5 million. Or I would start maybe a real estate company that does mortgages.
Why did you pick that versus starting like a new AI company or something?
Yeah, I have definitely seen some pretty miraculous things from AI when I've demoed some people's iterations of a new version of AI that just came out from OpenAI called O1. I was really, really impressed, and I think it can do a lot of stuff. But I think ultimately it would not replace enough of the activity for enough of my customers that I would want to bring that to market relative to just like showing consumers the new way. I just get really excited about coming out with a net new view of the world for consumers rather than trying to come to what are sort of the patchwork quilt of technologies and companies over the last 3 years and then trying to bring AI in there. I think somebody should do that. I think those companies should do that. But if it was me, I just get really excited about showing consumers a new vision for how things could work. So I'm just always stuck trying to help people in the end, the actual consumer.
Well, and that's one of the reasons I started the commentary. I mean,
Mhm.
if I figure if I can help one person help one borrower, it's worth
That's
my
right.
commentary.
Hey,
And
I
if
like that.
if I
Yeah,
can
exactly.
obviously I've been able to leverage that to some extent because I like to think that I've helped more than one
More than
loan.
one, I would say so. Yeah. Well,
Uh,
and also think about that reach because as we change the minds of people who are able to touch thousands, hundreds of thousands, millions of people in this like critical thing, the ripple effects are pretty dramatic when you can do that. That does get, I mean, that the scale of this business and the scale of this industry still is incredible.
yeah.
It's tremendous.
Let me ask you something else. It's a lot of people on the call may not go to conferences on a regular basis, but there's a game in the movie in the parlor game where it's degrees of separation from Kevin Bacon. Like
Yeah.
you can name a movie
At
star,
6 degrees of Kevin Bacon or 7 degrees of Kevin Bacon or something. Yeah.
Kevin Bacon. But do you think that you or I or anybody on this call within 2 or 3 leaps would, could touch anybody in this industry?
Yes, I do.
That fascinates me for some reason. I don't know why,
Yeah.
but
Uh, I have found that there had historically been some dividing a little bit between the networks of bank mortgage companies or banks that do mortgages versus independent mortgage bankers, that the over the last, call it 10 years or 50, that the amount of people have moved back and forth between those networks are now as intertwined as they've ever been. I think the capital markets and warehouse lenders have also sort of intertwined those, and so much of the business shifted to Fannie Freddie business, FHA business, that everybody's doing largely the same stuff all the time. And so for that reason, I think a lot of the networks that might have been isolated historically have now just kind of, hey, we're all doing this business, we're all doing it together. We largely, there is still some like lobbying issues that are different for banks than mortgage companies a little bit, but by and large, I think it brought everybody together, and the 2 to 3 moves is probably about right. What do you think?
yeah, I agree with that. There is a school of thought that feel that the line between a broker originator and a independent mortgage banker LO is pretty blurred. Um, certainly the skill set is transferable, and
Mm,
can't we all just call them originators and call it? Does it have to be an IMB LO or a broker or a
right.
bank, originator and so on? Can't they all just all be originators and call it a day? But
Yep.
that's probably take a little while.
I
So
I I kind of default whenever I'm talking about it as like a mortgage professional or mortgage pro, and that has been my solve. But then Robbie always says it sounds like I'm saying mortgage bro, which has also historically been true, and we're trying to change that. So we gotta stick with mortgage pro, but make sure I'm enunciating it accurately, I suppose.
pro with a P, like
That's right.
potato. Anyway,
So I'll ask the last question. We'll wrap on this. Is there anything outstanding that you have as a question in your mind, like a rumor you're trying to track down, or just something you've been curious about that you're looking to answer in the next 24, 36 hours?
I've I'm gonna you and I are gonna be having lunch with Attorney Brian Levy.
Yes.
I'm unclear as to why United Wholesale can bring brokers into Detroit and pay for their trip and have that not be a RESPA violation. So I think
Right
I'm
on.
gonna press him on that.
Get a little a RESPA tutorial during our lunch. I'm looking forward to it. Well,
RESPA for dummies.
thanks for jumping on, especially on somewhat late notice as we juggle the conference life here in Denver. And
You
for
bet.
everyone that logged on, thank you for watching live from MBA Annual, and we'll post this on YouTube, and everybody will be able to get it on LinkedIn and YouTube after that. So thanks, Rob. Really great to have you here.
Very welcome, Jeremy.
Take care.
Bye.
Bye.